let's turn the conversation over to inflation in particular. So with some obvious similarities between today's inflation outlook and the 70s, or at least I've been told. So what should we expect from history? Should it repeat itself? For his thoughts, investment management partner at Cameron Harrison, David Clark, joins us now. Now, I love your note. It's got a Skyhooks reference in there. Perhaps we're a little more hi-fi here. We'd have that playing in the background right now and, maybe descend a disco ball from the sky before we start our conversation. But you're saying perhaps we shouldn't because although there ostensibly some similarities between what's happening now and the 70s, there's not enough to use it as an indicator of what could happen in the future. Is that about right?
Yeah, quite right, Carl, and thanks for having me on as well. It's pretty easy to draw those analogies between what happened back in the 1970s, an oil price shock that drove a wage price spiral into an inflationary environment. But there are some pretty key differences between what happened back then and what happened now. Principally, in terms of independence, independence of central banks has improved vastly since back then. So back in the 70s, really the Nixon administration pressured the Fed Reserve to keep rates low, and that led into sort of inflation and growth after that. Also, they had wage controls back then that when they lifted them, suddenly had really strong wage growth. And probably the most important one is the demographic shift that they had then. They had a vast increase in the number of working people, both as a combination of the baby boomers reaching their 20s and also increased participation from women in the labour force. And that was really what drove that inflationary spike that persisted for many, many years into the early 80s until they had to really clamp on rates in the late 70s and early 80s. If we look at where we are here, we've already sort of moved into that aggressive central bank tightening position, and from a demographics and labour force situation, whereas the labour force grew at circa 2% back in 1970, we're actually going to have about 0.5% per annum labour force growth. It's just not going to give that inflationary pressure that they had back in 1970.
We'll touch on that in a second too, because you did have a chart on the US labour growth story, I guess you could say. I just want to add ask one point too, if it's a factor that, one thing that seems to be a big difference between now and the 1970s is kind of the institutional makeup, especially when it relates to industrial relations, greater bargaining power amongst workers potentially. Is that a factor here as well, that we might not see the same kind of runaway inflation just because workers don't have the same power that they did in the 1970s to drive wage demands?
Yeah, well, certainly in the US, you had a much stronger sort of union movement back then, and then the rise of the gig economy and the like has sort of weakened their ability to negotiate wage growth as a collective. Certainly that will have a part to it, but I think more importantly, it's just that the economy is not going to be allowed to run for as long as what it did back then.
Well, let's get that labour growth chart in the United States, because it really is illustrative. Would you like to just expand on that a little bit further? Because it kind of seems to suggest that there's a pretty clear and secular trend there, and that maybe sort of bodes perhaps poorly for long-term growth prospects. It sort of harks back to me again, that kind of Lawrence Summers argument of secular stagnation, that maybe that trend hasn't necessarily continued and maybe it'll extend itself. What are we looking at here?
Yeah, quite right. So the green line there is your labour force growth in the US per annum, and then the grey line there is just your population growth. So post-World War II, you had the baby boomer growth spurt, and then in the late 60s, early 70s, those people are starting to reach their 20s, they're entering the workforce, they're having families buying houses and the like, their spending patterns go up significantly, and that really drove economic activity during the time. Likewise, you also had greater ability for women to join the workforce, so you get a big increase in labour force participation. Then pretty much from 1980s through to today, we've had the reversal of that. So growth rates have slowed, so population growth is slower. You can only have that big increase in terms of female participation really once, so that's slowed up as well. So what we see going forward into the 2020s is really wage growth that's more around that 0.5% per annum, and that's probably more disinflationary from a demographic point of view rather than inflationary. So central banks will have to do less to keep inflation under control. Where it means in terms of long-term growth, I think there's probably one big change that's come out of the pandemics, in our view, is just the return of fiscal stimulus and the big increase in terms of budgets that you've had. Spending on, particularly social elements of budgets are very difficult to take away. We've had a large increase in the NDIS forecast spending. You've got a big amount of spending on defence required. So although growth driven by population or workforce participation will remain to be weak, and so that secular stagnation element, you will have more fiscal spending built in over the forecast.
Interesting. I've got two questions to ask further to that, because one's about interest rates and the other is sort of related to credit cycles. But I assume if you overlaid the 10-year yield on that chart, you'd see a pretty handy correlation there with the labour force participation. I don't have the chart in front of me again right now, but that green line there looks very similar to the 10-year yield. Is that effectively a bit of a signal that we might be topping out, you think, in global bond yields now, given the fact that, again, if we're not seeing those kind of longer-term structural drivers of growth, that inevitably growth will slow down, price pressures will slow down, we'll see yields move lower again, and that, say, for investors, buying bonds at this point in time might be a fairly attractive proposition. Is that an argument that might hold water?
Yeah, it is. So I guess the characteristic of secular stagnation over 40 years is the progressive lower lows in the cycle and lower highs in the cycle in terms of bond rates. And that's brought us for the last 40 years to where we are now. We think that the next 10 years, you'll actually see bond rates peak a little bit higher than they have in the previous decade, and that's due to the spending that you're having from governments in fiscal and the like, which will drive into infrastructure and those needs. So that has an element there. In terms of the bond piece of it, I think Jeremy touched on this as well, but there's very different pathway forwards in our view between Australia and the US. So the US, where wage growth on Friday was above 5.1%. They've been running at wage growth in 6 to 7s and their inflation in double digits at various points in time. They've got further to go in terms of this tightening cycle. We'll have to go higher, and that will naturally see long-term rates also a bit higher. So there's some weakness there in terms of duration for bond investors. On the flip side here, the RBA have been earlier in terms of their tightening cycle relative to where inflation was at the time. We didn't have a period in 2021 where wage growth was particularly strong, like it was in the US, where it was running at 6 to 7s. So, we view the forecast for bonds in Australia to be overly hawkish. So there is an attitude there where you can start to look at adding a bit of duration into your portfolio. For us, we've largely been on the floating rate credit side position for the last couple of years, and that's performed quite well. But we'll look to increase our allocation over there and take advantage of what overly hawkish expectations in terms of rate cycles.
Just one more question, again, it relates to that sort of credit cycle. Clearly there's a large accumulation of debt for several decades, especially in the United States, and a lot of that overhang of debt is one of the reasons why that central bankers won't need to lift interest rates particularly high to be able to slow the economy, because once it goes off, the cost of servicing that debt increases, slows growth, etc. Will what we see now, again, with this kind of change in dynamics where governments are still feeling pressured to be able to, obviously provide particular services, particularly, long-term liabilities that need to be covered and aren't necessarily financed right now with any sort of source of income, that we'll see increasingly a kind of bump in that credit cycle because governments are going to increasingly take, again, spending measures, pop that on public balance sheets, boost growth in the short term, but again, in the long run, it'll have to sort of peter out once that kind of, sugar hit from greater fiscal spending, wears off and hits its limits as well? Yeah,
there's an element. I guess from an Australian perspective, we've historically run with actually quite low levels of public debt. So we've had that opportunity to catch up, and there's been definitely a change in the attitudes and rhetoric around having balanced budgets to having budget deficits that are relative to GDP, so a constant debt to GDP position. So that actually gives them the position where they can actually run structural budget deficits, fund these expectations around social spending over the next decade without that need to harm the economy by tightening up. From a credit rating perspective, I think Australia is still reasonably well placed as a growing population to serve those needs. So I don't think you're going to see that blip, if you like, in terms of the credit worthiness of Australia. And then the US, being the default reserve currency of the world, has that added safety net there in terms of their ability to fund their balance sheet.
Just finally, and one last question brings it a little bit closer to home, is just what's happening at the moment in terms of the swaps market. And I can see we've got a chart here that we might be able to chuck up, which is just the divergence that we're seeing in swap rates between Australia and the United States. What do you think that's communicating at the moment? And I see your note here just about the potential drag that will have on household budgets in Australia if rates were to potentially move that high.
Yeah, so I think it's important to note the differences between Australia and the US, and actually most North American developed economies in terms of how their mortgages are structured. So in the US, 90% or more of the mortgage market is fixed at 15 to 30 years. So when the Federal Reserve increases rates, that doesn't actually flow immediately through to household budgets because their repayments are fixed. They used to have a more similar or balanced structure of their market, where it was 50-50, but in the aftermath of the global financial crisis and the housing crash, it almost all went to fixed. In Australia, we're the reverse. There is some fixed mortgages, but they tend to be very short, 3 to 5 years. So almost everything is variably priced. So as soon as the RBA increases rates, it hits household budgets far more immediately. So if we look here, we find it very hard to see why the pathway for the RBA would follow that green curve there, which is the Australian expectations based on overnight index swaps. So despite the fact that Australia's wage growth is in the low twos at the moment, albeit likely to increase later in the year, and the US is at 5, and their inflation is significantly higher than ours, they're expecting that the RBA is going to tighten as hard and then harder throughout the cycle than the Fed. I think given the sensitivity, the amount of debt that households have relative to the property market here, if they were to do that, you'd see a pretty dramatic fall in prices for housing and fairly significant harm through to the economy that was likely to persist for a number of years afterwards.
Really interesting stuff, and I love that kind of long-term historical perspective in terms of trying to make asset allocation decisions and just getting a better understanding of what's happening in the world right now. So really appreciate your time today. David Clark, we'll let you go, but would love to get you back on the program shortly. That's David Clark from Cameron Harrison.
Thanks, Carl. Have a great day.
You too.